Good afternoon, everybody. Welcome to the next session on new ways of data visualization and market trends with Alex Cole. Here is our brief introduction.
It is now my pleasure to introduce to you the host of our next session, Tyler Wood, our very own Managing Director of Global Business Development for the CMT Association. As an executive manager over the past 20 years, Tyler has built and brought products to market in the education technology space and the financial services industry. Throughout his career, Tyler has managed brand, communications, and sales teams to drive top-line revenue growth for private, public, and non-profit entities. Prior to joining the CMT Association, Tyler worked in management consulting and publishing. He received his MBA from the Kelley School of Business at Indiana University. Among his many talents, he can drum up a mean song and a Bengali bean curry with equal ease. In this session, our guest Alex Cole will walk us through examples of how using code to blend several indicators can give analysts a new chart type that clarifies trend indicators without obscuring the most important signal of the market's price. GoNoGo charts allows for a clear understanding of the volatility that we are experiencing in 2020. Alex will cover charts from the major global indices, sectors, and individual securities. He will look at them all against the backdrop of trend capture and risk avoidance. Whether investors are using simple moving average strategies or a more complex blend of trend following and momentum inputs. Alex Cole is a technical analyst and charting product specialist. With over 14 years of financial market experience, Alex has led technical analysis and data visualization teams frequently and has frequently contributed to financial news industry organizations such as Bloomberg and the CMT Association. He has helped direct both business strategy and software development. He created the popular chameleon indicators on the Bloomberg terminal. Tyler and Alex, over to you.
Can't hear you, Tyler.
Oh, how about now? Are we back?
Perfect.
Don't worry, I just said the most profound and hilarious things that you ever would have heard, but we can't get
Just
that
like any other chat with you.
That's right. Just want to welcome Alex Cole, who's a dear friend of mine. I've known Alex for well over a decade, both through his roles at Bloomberg, as well as being a subject matter expert on technical analysis education for Wiley. So Alex, thank you very much for joining us. For those of you around the world, it is currently 6:33 a.m. on Sunday morning in New York, and it's a little earlier than I normally get to talk to you, Alex, but we're excited for everything you're going to share with us today. Let me just switch over the controls to you, and we'll be off and running.
Thank you very much.
Thank you.
So thanks so much for having me. It's an absolute honor to be presenting today. It's great to see so many of the people in our field and in our industry getting together, even though it's virtually. in such a strange year, but a busy year for us in finance. So it's an honor, and thanks to the CMT for putting it together. What I wanted to go through today is a new way that I've been viewing the markets. I say new, but it's been in development for several years. And what I've done is I've tried to create a suite of technical tools that allow me and clients to view the markets in a simple way, but one that I think is a complete overview of the technical markets. So I'm going to just 1 second, show my PowerPoint. All right. And again, and let me know if you have any problems seeing that. But I've had a little bit of a trouble with the PowerPoint this morning. It was pausing every time I tried to play through it on the webinar. So hopefully you can see this now. I think that you can.
It's looking crystal clear, Alex.
Perfect.
Yeah, that's great.
Perfect. But so what I'm going to show is the GoNoGo charts, and I think that they give an overall robust view of any market really in terms of trend and momentum. And so I'll give a quick overview of how they came about, the story behind them, the purpose that they serve, as well as walk through many of the indicators, and then take some time to go through some current charts of, hopefully the types of things that we're looking at: major indices, major assets, major companies. And then finally, I'll just leave off with how you can get in touch with us if you want to keep up with what we're doing at GoNoGo Charts. So to start, how did I get here? Well, the genesis for this idea was that I was having a problem. And during my time at Bloomberg, where I ran technical analysis teams, and I grew fascinated with the idea of trying to work with traditional concepts that my peers and clients all agreed had lots of value, but then tried to turn them into systems that were easier to understand due to the power of data visualization. So I got very much into using visuals and using data visualization to try to simplify the information that I was giving to clients and using myself. And what I mean by that is, if you look at this chart, it's a chart with an incredible amount of really good information on it. Concepts, techniques that I'd learned to value over time and over my time studying and researching technical analysis, and ideas that have stood the test of time. Trend ideas, momentum ideas. But the problem that I was finding in a lot of my clients was, once you build a chart and you add panel after panel and you add indicator after indicator, the chart becomes complex and overwhelms price itself. So if you look at this chart that I'm looking at here, it's very difficult now to view price action and find significant levels, find those support and resistance levels, or that significant price action that we're all looking for. Now, for some, the value was just in being able to be clearer in explaining technical process and technical views to their clients. So if I was talking to sell-side research, they were looking for a way to simplify the explanation that they were giving technically to clients. And for others, it was just to ensure that they didn't miss what their charts were telling them. So technicians using charts themselves were keen to not miss any significant changes in technical environment. And for me, it was a bit of both. In articles that I wrote or teaching technical analysis to new traders, new analysts, being able to simplify the view when I'm discussing a concept such as support and resistance or trend, then simplifying the view has a lot of value. But then when I spoke to clients who wanted me to clean up their charts or wanted to discuss ways to view their technical process, I was able to code custom indicators for them that sort of represented their strategies in a way that helped them without missing things that were happening on the charts. And that was really exciting for me. And then in my own research, in my own analysis, in my own decision making, it became logical then that I wanted to take what I'd learned, hold on to the things that I thought had value, the specific indicators and concepts that I looked at every day, and then create something unique for me that I would be able to share with clients and colleagues that allowed me to understand really any market that I looked at, so that I could talk to people in that area of finance from a trend and momentum perspective. And so that allows me really to discuss market environments, to better teach the concepts, to discuss what's happening with clients. And so I did that primarily creating a system that color codes price. So this is where I ended up with as the solution for that problem. And I've called it the GoNoGo chart. The idea being that we can identify if we're in a go or a no-go situation for sort of launching any investment. So this is where I ended up. The answer was to blend the concepts that I wanted to look at in my chart using a calculation that brought them together to color the chart so that I could understand it easily. Now, this is my current system, and the one that's taken a few years to refine. And believe it or not, there are more technical concepts and technical tools, more information in this chart than a chart, the chart you saw previously, or a chart that you might see on a screen with several panels and all these great technical concepts. But there's a lot of information in this chart, but it's still primarily a price chart. So if I wanted to draw a trend line during this major up move, I can still do that easily because it's not being obscured by indicators and other bits of analysis, making the chart harder to read. And I also, just to make a quick comment, I really strongly believe in the value of that simple traditional analysis. I look for areas of support and resistance. I draw trend lines and other lines creating the upper and lower bounds of triangles. I believe in identifying support and resistance in that way. And so having a large price chart that's easy for me to create those kinds of ultimately decisions on what's happening on the chart was really, really important. What are we looking at here? Well, in the top panel, that's the go-no-go trend indicator, and it colors the chart based on several concepts and gives a go when the environment is bullish. So in that way, the brightest blue is the most bullish. And so what I find is, for me, I don't need to have several indicators on the chart, because I know that when the chart is colored brightest blue, then the criteria that I value for trend identification are being met. The shades of purple then represent the bearishness of a market or a no-go environment. And again, this is telling me that my criteria for bearish technical environment, those criteria are now being met. Now, an important element just to quickly look at here is that I did want to build in the ability to show weakness when in trend. So if you look at the normal pullbacks in a trend here, you have a pullback in the middle of the chart and then a pullback later on. Those are a paler aqua color. And we know that pullbacks and corrections happen in any trend, but this allows me to be prepared, to be watchful to see if the trend can resume, or if there will be perhaps a change in trend and a move to the opposite environment. And we'll talk a little bit later about the oscillator in the lower panel and how that can really help identify or tell us when that trend will continue instead of reverse. So amber here is the neutral color, and that's typically painted as a bridge between trend changes, between those changing conditions of bullish and bearishness. Now, just as a little background, the go-no-go terminology comes from a pass-fail type of test used in the military often and in NASA, as in it's a go for launch. And so that was my goal and idea, was to visibly demonstrate when market conditions are a go or a no-go for investors, without, as I said, muddying up the chart or overwhelming price with those panels and indicators. As an aside, I've also found that the color change often coincides with important pieces of price action, and we'll see that when we go through some live charts in a little bit, and that really adds weight to the signals of go-no-go charts and also traditional analysis. So you can see here how this trend is changed, and you see the amber bar towards the end of the chart that leads into the no-go. That would likely be on a break of a trend line. And so that's pretty important information as well. Now in the lower panel is the go-no-go oscillator, and really used in conjunction with the go-no-go trend. And when you do that, you get a complete overall picture of the technical analysis that's in the chart. And like the trend indicator, it's an oscillator, and it's like the trend indicator, it's a blend of many of the most well used and traditional concepts, but this time in the momentum arena. So ideas of price behavior and supply and demand relationships, providing the user with hopefully what I think is meaningful momentum analysis. So we've got one price chart and one momentum chart that gives, I think, an overall view. So it's the only oscillator. Again, there's many inputs to the oscillator, but it's the only one that you hopefully would need to look at, because I know what's happening from my input indicators based on what's happening with the oscillator. Now, like the trend, being able to combine the go-no-go trend with traditional trend analysis, you can do very much the same thing with the momentum, traditional momentum techniques using this go-no-go oscillator. Like any go-no-go oscillator, you could use it, any oscillator, you can use it in a traditional fashion. So momentum extremes is something that you'd look at closely. You think about the idea of using an RSI and looking at when it becomes overbought or oversold. You can, of course, look for those areas of overbought and oversold extremes using the go-no-go oscillator as well. And I also look for divergence, as I would with any traditional oscillator. And you can see here towards the end of the chart, really strong divergence, price making a new high, the oscillator not. So if that's happening, then you've got cause for concern using traditional momentum analysis with this oscillator. So what I'm hoping to sort of get across with this is that you aren't losing the power of momentum techniques with the go-no-go oscillator, but getting a blend of momentum concepts in one. And there's also a volume piece to this, which is, as you can see, where the oscillator is changing color to the darker blue. That's letting me know that the volume is higher than average for whatever it is that I'm looking at. And that's obviously can be valuable as you study trend and momentum shifts. So the next thing that I want to talk about is the interaction of the oscillator with its zero line. So hopefully you can still see the charts well, but this is a very valuable concept, and it's one that I'm really finding a lot of really strong feedback from people that I show the go-no-go charts to. We know when we look at a trend, we know that there will be pullbacks and corrections. What we don't know is how steep they're going to be, or how dangerous to the overall structure of the trend that they're going to be. And I've used, the main oscillators, obviously, for a long time, RSI, stochastics, and many others. And they're really some of the most used indicators by all technicians. And although they may not have been primarily designed for trend analysis, right? They're trying to identify velocity of price movement when prices swung too far in one direction. An oscillator is trying to give you that overbought value, and then when you see a cross back into neutral territory, the idea is that you might mean revert, especially in the short term. But there's a lot of work that's been done trying to understand how momentum oscillators react within a trend, and can they be valuable for us to look at during a trend. Now, the difficulty is with this is, yes, there's a lot of value that can be had looking at oscillators in a trend, but we can't quickly see where an oscillator may find a level that's support. In a trend, an oscillator will be unlikely, if the trend is strong, to move from areas of overbought extremes to areas of oversold extremes. More likely, it'll range from one extreme to neutral. So if you're in an uptrend, the oscillator will go overbought and then fall into neutral, go overbought and fall into neutral. And that makes sense if you think about it, because you're looking at excessive buying in a healthy trend. There should be lots of enthusiasm and lots of buying when the trend is strong. So there's been writings about using RSI and can you find a range of RSI to get support and resistance. For example, a lot of people that I've worked with in the past use 40 and 80 as a range for RSI, a trading range in an uptrend. RSI will rally up to extremes above 70 and then will fall into neutral territory, and we'll look to see if RSI will find support somewhere around perhaps 40. Unfortunately, it's unlikely that any oscillator, RSI, whatever you might be using, will consistently and neatly fall to that same level every time. It might be 43, it might be 38. The oscillators are quite jagged in their movement. So to find a situation where there is a consistent level of support or resistance is very, very unlikely. So I wanted to build something into this oscillator that had a hard level, a hard line of support and resistance. And so in that way, there'd be no need for us to subjectively find a level. You know, it looks like 35 is working in this case, or let's see if 40 can be support for the oscillator here. If I could build in an objective level of support and resistance, then I thought that could be valuable. And so the GoNoGo oscillator is calculated in a way that when the oscillators within it are neutral, then the value of the GoNoGo oscillator falls to 0. If we're in an uptrend, it'll fall to 0 from above. If we're in a downtrend, it'll rally to 0 from below. And so in doing that, we've got a hard line of support or resistance at 0. And I really can't overstate how important this is, how integral this is to the system as a whole. Looking within a trend and then seeing if the oscillator provides support tells you a lot about the strength of the trend. Think about it in another way. If the price rally is healthy, momentum will swing up to overbought every time there is heavy buying, every time there's investor enthusiasm. And then it should cool off when price takes a pause, or when people take profits, or whatever it might be. But it shouldn't, in theory, cross over into negative territory. That would be a cause for concern. And because of this, we can expect price, as it does in this chart, to bounce off the 0 line in a healthy uptrend, or get turned away from the 0 line in a strong down move. And we're going to see lots of examples of how this works when we look at the live charts later on. But hopefully, even in this example, you can see a nice consistent move up. You can see the pullbacks highlighted with a bit of weakness in the trend with this paler aqua bars. But then every time the oscillator rallies off 0, as it should, then we indicate that on the GoNoGo chart with these green circles, which we call low risk entries. So all the way up the trend, whenever there's a surge in momentum and then a pullback, we will identify that for you as a low risk entry. So that's quite a lot of talking. I'll take a pause, have a cup of tea, or have a sip of tea if you've got a cup of tea. It's early for me as well, Tyler, this morning. I'm where you are. But I think it's important to just go through the main calculations and indicators of GoNoGo charts before we crash on with some live charts.
I think that's fantastic, Alex. And we've had a couple of questions just in the chat box from attendees who are interested in understanding the component parts of what goes into GoNoGo charts. I know you're gonna go through each of the tools, and I've done my best just to answer a few of those from what you were saying about the component factors just in GoNoGo trends. But if you wanted to answer more specifically or less specifically about sort of where you find a lot of value in traditional commonly found technical indicators, that'd be great.
Absolutely, yeah, I'd love to quickly. So it is a proprietary system. However, it's the real sort of genesis of the idea was to not do anything crazy with what went into it. So my view was always, if everybody's looking at RSI, then that's an important piece that should be in a technical system. If everybody's looking at where the price is above or below a moving average, that's an important concept. A moving average, just if you state it as simply as possible, if you're able to make the statement that price is trading above its moving average, you're saying that price currently is trading higher than the average of its prices over the last however many periods. And so that's inherently bullish. Price is higher than it has been on average over the past 50 days, 100 days, whatever it is. So the simplest ideas, sometimes the old ways are the best, and sometimes try not to overcomplicate things is a very important idea in financial analysis. And so while it is a proprietary system, really the most used, most tried and true, the kind of things you'll read about first in the textbooks. Just to give you an idea, in the oscillator, of course, RSI is in there. Bollinger Bands feature in the system. Moving averages, and when we're looking at trend, even moving average convergence divergence, MACD, is the MACD greater than some of its components or greater than zero, all identifying conditions. And the important thing to remember is that we want to be careful of looking at too many of the same things. That's why we need to separate them out. So the GoNoGo trend is, I'll say that it's some of the most common trend following ideas in technical analysis, things like moving averages. There are some other things in there as well, obviously. And then in the oscillator in the lower panel, that's a momentum indicator. And so those are some of the big hitters in the momentum oscillator world. I didn't want to put anything into these indicators that was, unusual, or it's not trying to find a magic potion. It's just saying that there's value in taking the most well-used indicators of trend and momentum and blending them together into a visual that makes it hopefully easy to identify and still have usable charts. Hope that helps.
That's a really great point you just made, Alex. In terms of the redundancy or even conflicting nature of some indicators that are within the same class of measurement, and there are derivative more nuanced ways to do many of the same things. But we've all seen that junior trader on the desk who has 1,000 lines all over his chart. He has no idea, he or she has no idea what they mean. Yep. But the boss sure thinks they look busy, right? The chart is just chock-a-block full of extra indicators.
My father is a maths professor, and he used to hate the fact that maths professors or teachers in general almost seem to like the fact that people found maths hard. And I think that there's a little bit of that here too in our space, in finance in general, is that you pull up a very complicated chart, technical chart, then it's kind of, well, I understand it, and it gives perhaps you don't. It's an interesting dynamic that we see. And my dad was always of the belief that maths could be made as easy as possible for kids. And I think that there's an approach that you could take in that way here. It's one thing to understand your own chart, but if you ever need to explain it to somebody, then you want to really simplify these concepts and display them in a way that makes sense. That was the goal anyway.
Well said. We've got one more question. Well, a few questions around the same concept. Nilanjan Ray was asking about the time frame that GoNoGo charts work on. So is this just for long-term investment? Is it only relevant for end of day or week or monthly charts? So I know you're going to get to some live examples of Indian equities. Maybe we can see those on multiple time frames.
Sure. It's a technical indicator at the end of the day, like any other that's worth its salt can be applied to any asset on any time frame, any periodicity. So I have people using these even intraday down to 5-minute charts. The idea is the same as it would be if you were looking at RSI. We're looking at periods of the chart for calculation. People's preference, I'll leave that to debate in the audience. What's the best for technical analysis? It really depends on what you're looking for and your risk exposure and your parameters there. But the indicators themselves can be applied on a chart just as any other. Like a moving average can be a daily moving average. It could be a 30-minute moving average. And we'll get to a couple of charts where I do believe that I've got a couple teed up that are looking at some intraday 4-hour charts and things like that.
Excellent. I don't want to keep you from getting to the other components of the GoNoGo charts tool set. Nilanjan was also asking just about, is it only for longs? Many of the no-goes look like good shorts.
I will be able to show some. I always sort of tend to show longs in PowerPoints and demonstrations because we all want to be bullish. But yeah, it definitely the no-go, it works in much the same way. We're looking for those criteria that represent a bearish environment, and we'll see how it's actually been a great year for charts for a lot of technicians, but for GoNoGo, there's been a lot of you'll see on the charts the tumultuous markets are shown quite clearly with the go and the no-go. So yeah, not just for longs. We'll get to that as well in a second. So shall I? I'll just plow on here and get through. I'll go quickly through some of the other tools, and then we'll get into the charts. If that sounds good to you, Tyler.
That sounds great, Alex. We've got about 20 minutes left.
Okay, perfect. So I'll roll through these. So the next few slides are showing GoNoGo indicators that are based off the sort of original ideas in GoNoGo calculations. So these will be fast to go through because we already now have discussed the idea behind them. This is called the GoNoGo squeeze. And the way this indicator works is it tries to identify areas of reduced volatility. And how it does that is looks at the oscillator and identifies areas where the oscillator has been riding the zero line. So if you think about what we discussed with the oscillator, when the GoNoGo oscillator is at zero, we're saying that all of its inputs, its momentum inputs, have fallen into neutral territory. So there is not a overbought or oversold reading coming from any of the inputs that are in the oscillator. So that's a sort of consolidation environment, a reducing volatility. Think of it as, in a way like narrowing of Bollinger Bands. And you'll see on the chart often a shrinking of volatility as price bars get smaller and we perhaps consolidate sideways. And we know as investors that this often leads to a significant directional move because that old analogy of squeezing the toothpaste, eventually price will move in one direction or another. And the idea of the squeeze was to highlight that on the chart. So this squeeze is this climbing grid that you see in the bottom panel. And that's just identifying those areas where the oscillator has ridden the zero line for a unusually long time. You can see a couple of squeezes here on this chart before then a go flag was finally triggered. And we also then got a low risk entry, this green circle, before a nice little pop up as the oscillator was able to rally off that zero line. So that's the squeeze, identifying reduced periods of volatility. Maps, and I have a few versions of maps, relative strength maps, heat maps. This is a relative strength map of the sectors, the 10 sectors of the S&P, and this is based on just taking the go-no-go trend calculation and applying it to the ratio of each sector to the base index. So the relative strength, we know relative strength is simply price divided by price of two components. And so we're just applying the go-no-go trend to that ratio, and that gives you a nuanced view of risk on, risk off, not risk on, risk off, but a nuanced view of the attribution or the leaders and laggards of any situation. So we can see here that you'd be quickly able to identify leaders and laggards. You'd be able to visualize those assets or securities that have been doing well. And you can make attribution decisions then based on trend identification of the assets within a group. So it could be portfolio, it could be sector analysis, it could be the G10 currencies. You can see here that in this map of the sectors, you can quickly see which ones are in blue go trends, which ones have been in the no-go trends, which ones are changing trend. Down the bottom here, we've got utilities having been in a strong no-go throughout the rally that we've seen, now flashing a go trend on a relative basis. So that's maps, really just a nice way to see rotation and like I said, to be able to attribute performance, outperformance, and underperformance within a group. And then this one is a map of a risk proxy. Now, I really like the idea of this because we can hard code a proxy of risk and then apply the go-no-go trend concept. Now, this will help people evaluate risk exposure, take advantage of conditions maybe favorable for adding risk, and alternatively to protect, of course, against downside risk when necessary. Now, I've used a very straightforward idea for a risk proxy here. It's just high yield bonds to treasury bonds, but any ratio can be put into this indicator if you have a different idea that you want to test. Now, the value in this is that you can have a chart of any security on the top panel with the go-no-go price chart and the go-no-go oscillator, and then a hard-coded proxy for risk on the bottom. And it's a really nicely sort of somewhat sophisticated view of risk, because it's not just looking at the simple risk on, risk off of the ratio, but applying the go-no-go trend to that ratio. And you'll see typically that the risk starts to creep in, as it did here with these 3 amber bars earlier on in September, before we had the slightly heavier correction that we've been experiencing. And who knows now if that will continue. We've really come back quite strongly over the last week, so much so that the oscillators crossed back above 0. You can see that here, and also we've got our first pale go bar on the risk indicator. So those are some of the ways to use the go-no-go ideas and concepts to create other indicators and other visuals that round out the picture, so to speak, to give you that overall view. So let's look at some charts. I'm going to go to my charts here so that we can just pull some up. And what we'll start with is some of the indices, and then we'll move on to maybe looking at some of the asset classes that are important. I especially want to pull up an oil chart, and then we'll go through an cross rate, FX rate, and then some stocks. We'll see how much time we have before Tyler kicks me off the screen here. But this is a chart.
So Alex, just before you dig in, and we have about 10-12 minutes left. There were 3 questions that came in.
Okay.
From Nipun, Amit, and Tirth, asking if the charting system is available on TradingView or only on TradingView, where they could get their hands on these charts.
Yes. So right now, this is a TradingView chart that I'm showing you. We are building a tool that will, allow us to have a little bit more freedom to create on GoNoGoCharts.com. But right now, anybody that wants to try these, we are enabling people. If you have a TradingView login, just shoot us a message, info@GoNoGoCharts.com, or go to the website, and we'll get you enabled. We're doing an extended free trial of all of these, But yes, we're working on making them available in as many places as possible. But right now, if you have a TradingView login, please shoot me a message. So this is the Sensex index, and this is a great. Actually, one of the charts in the PowerPoint was lifted straight from this. So we've seen this before. In this period here, where we saw the rally and supported by the oscillator over and over and over again, giving us those low risk entries all the way up, was a chart that we saw. What you'll see is that when the oscillator is unable to hold that zero line, that's very, very important and leads to further correction. So you'll get warning of that ahead of the move in price, as any oscillator should lead the markets. So you can see here in September, this is the first time that the oscillator really struggled to hold and find support at zero. And so we could have been therefore concerned and a little prepared for a stronger dip that we saw in price. Now this seems to have been a more of a correction rather than a new trend, and obviously I would always encourage multi-time frame analysis, and the weekly trend is up. So perhaps take not give as much weight to a no-go when the overall market bias is still up. But we have now recently had a go in the last few days, and a strong break back above the zero line into positive territory. So that's really a good sign to see. Now, if we go back a little bit in the chart, we've been talking about how, the no-go as well. You can see how the no-go comes in early on before we had that big crash, and the oscillator being below zero is what supports that. Now, let's move on though, because we saw that one a little bit. This is the Nifty, and this is an example of what I wanted to show in terms of using traditional technical analysis. You can see how we've got our support and resistance levels and lines drawn on here. Similar chart to the Sensex, obviously, but you can really see the importance of combining the traditional concepts with a system like this that color codes trend for you, because now the price chart is still dominating the screen. You don't have a bunch of panels and indicators all over the price, but you can see here that this gap, this runaway gap during the down move, was always going to be a trouble for the rally, and you can see how that is exactly what happened. So we could be looking at this saying we are in a go trend as of May. We're expecting resistance here at this horizontal level because of the gap that we've seen before, and so we see this pullback. We see the weakness highlighted by the aqua, but then we look to the oscillator and say, what will it do here as it rides the zero line? And once we get those low risk green entries, then we're like, okay, the momentum is supporting the bullish trend, and we then expect it to make another attack on that level, and we see consolidation again. We see another crash to zero on the oscillator, another rally, and another low risk entry, and that is showing us that throughout this attempt to get back above the gap and above prior highs, the oscillator was able to find support at zero, and price was able to rally further. So it's a good chart to show how we can look at the traditional analysis with the GoNoGo charts. And if we zoom in a little bit to the later stages of this, you can see that, as I mentioned, I think if you remember during looking at the trend, that color change often happens on breaks of significant levels. And so again, we have these highs coming from the previous price moves, and then a break happening on the color change to the new go flag in conjunction with a significant break of the zero line. So right now, again, looking bullish, and we've broken above prior highs and oscillators into positive territory. So that's good on the Nifty. If we look now, let's look at an FX chart real quick. This is again a chart that really shows the importance of looking at the zero line. This chart has struggled with the zero line for much of the last couple of months, really sort of flirting with it, unable to get too far away from it. Right before this bigger drop down, then the oscillator was able to break into more negative territory. We saw it ride the zero line again. And on here now, I've just highlighted the previous lows for current price as it tries to test those lows. And we have seen the oscillator again struggling around and flitting around that zero line, but recently turned away by it. So this move down in price is going to be something to watch as it tests the previous low here. If I quickly pull up an oil ETF, let's it's very hard to see the uptrend here because the scale has been thrown off by the massive crash in oil, and we'll see that as a bit more of an uptrend in a minute when I zoom forward. But this was just an example of the identification of the trend using GoNoGo. You can see how it was back in January that the no-go was identified on oil, and then every step along the way, as price gets turned away from the zero line, we get now in a downtrend. Somebody was asking about the down or the short environment. We get the low risk entries into the short trend are now red circles. And every time the oscillator is turned away from the zero line, that leads to a renewed price movement down. Now if we move this chart forward a little bit, you can see how now in May the inability of the oscillator to stay below zero. So all else being equal, we would have expected in May the oscillator to be turned away from the zero line if the downtrend is still healthy. And so you can see a significant break of the oscillator of the zero line in May, then a ability to bounce off the zero line, followed by our no-go flags, and then now the leading to the identification of what would become then this new move up in price. Now this looks more like a normal price action. We get rid of the incredible crash that we saw earlier on in the year. So we've had, again, price moving up, oscillator being supported by zero. Not a lot of enthusiasm and momentum on the price moves, but the oscillator still doing its job to support price at zero. When it's unable to do that, it happens a couple of bars before usually a move down then in price. Now, right now we're seeing price again. If price is going to move down further, we will expect the oscillator to break back and stay below zero. If it's able to really consolidate above zero, we may see this tumultuous corrective period end and change back to a go trend being resumed. But that's
Alex.
Yes, sir.
If you don't mind me interrupting,
no.
Just thinking about some of those audience questions. If you took this oil chart instead of on a daily bar, what does it look like on a 15-minute bar? In terms of how the system changes.
Yeah, let's do that. Let's pull up. We could go to an hourly, for example.
Right.
Or even a what did you say? 15 minutes. 15 minutes is a bit rich for my taste. Yeah, but it'll work the same way. So there's obviously some gaps happening when you go intraday, but the chart works exactly the same way. I actually have one coming up, Tyler, with where I moved to a 4-hour chart. But yeah, the concepts will apply, and the same thing happens. Let me quickly, before one that's on a 4-hour, let me just show Reliance real quick, because Reliance has a nice, if I remember rightly, I'll have to change it back to the daily, but Reliance has a nice squeeze to demonstrate. So let me just show Reliance here. So this is Reliance, and you see this real, it's almost like the price, you can almost see the environment asking itself a question. What do we do? What's happening? You can see this rally in price all the way supported, right, by the zero line here. As the trend takes off, you've got the support from the zero line, and then in in this consolidation right, the shrinking of the bars, the really reduced volatility that you see here actually led to a couple of amber bars, which is the neutral color of the trend indicator. And this thinking, this squeeze really rising to extremes and staying for a while. And once the break is significant in one direction, we see that pop followed by a go flag and another low risk entry, that pop that takes price higher. Now we're doing a similar thing, consolidating sideways on shrinking volatility, and another squeeze is in place. So directionally, we'll watch to see which way the break is. Is it into positive territory? Is it into negative, to see which way the directional move might be in price? And I think this is one that I wanted to show on 2 time frames, Tyler. HDFC, housing development. I wanted to show this on a daily chart and then follow it up with a 4-hour chart. So just as an example, imagine that you are in a position where you are expecting a move up in price. You want to get long this security. Let's say you already have your opinion and you're looking for an opportunity to get long. And on a daily chart, we saw the squeeze again leading to a significant move down, but now we've had the oscillator rally up to the 0 line and break above it. And let's say you are in the market to get long. It's what you want to, for whatever reason, you want to get long. You can go down in time frame and perhaps look for the first buy signal on a smaller time frame. Because if you look at this, you're looking to get long, you've got some neutral amber bars, but perhaps you wanted to get long at a timely moment. If you go down in time frame, of course, then you can try to pick up a better entry. And so you can see how much quicker then you get the go flag before that sort of pop in price that caused the daily to become a go. So the 4-hour here is really just more sensitive, obviously, as you'd expect, and you get that break of the 0 line and the go flag earlier on the 4-hour. So because we all have different intention in the markets, and if you are sort of looking to add to a position, or you're looking to get long in a security, you can go down in time frame to find a good or a better entry than waiting for the daily to flag that go. So perhaps that helps. That's an example of how somebody might use the multi-time frames or the different periodicities when looking at a chart. Do I have time for one more, or?
I think we could make this one our last chart. But thank you very much for everything you've shown so far. This is great.
You're very welcome. It's always a pleasure.
Yeah. And I know for the folks in the chat box who are asking, you mentioned, tell us where we can find these one more time.
Yep. So I don't think I need to bring back up the PowerPoint, but it's GoNoGoCharts.com. You can read a little bit about what we're doing, and you can put in an email address, or just email me, info@GoNoGoCharts.com. Yeah, like I said, we're happy to put everybody on a trial of this. We've been getting great feedback, so we'd love to get more people giving it a whirl.
Excellent. And I can see the chat box blowing up. One more chart, please. Can we set our own custom indicators? Let's take a look at gold. So for everybody on the line today, I think this is an indication for us that we need to bring Alex over to India to do some sessions in Delhi, Mumbai, Kolkata. Take a tour.
Yeah, it would be my pleasure and my honor. And I'm passionate about the whole idea of bringing visuals to the charts in a way that makes it technical analysis is fantastic, but we want to make sure that we can see it. Sometimes it gets hidden. Yeah.
Alex, thank you so much for your time today. Everybody who's on, you've got that information. Reach out to Alex and make sure that you can use some of these tools for yourself. And at this point, we're going to sign off here, and I'm going to send everybody over to the Quant Meets Algo session with Abhijit Biswas from the IIQF. So thanks so much for being with us today, Alex, and we'll see you soon.
Thank you.